the central bankers love-in at Jackson Hole, Wyoming, attention is now swiftly moving on to the next meeting of the US Federal Reserve. This is slated for the 17th to 18th of September, and markets are currently putting a 98% chance on a 1/4 point rate cut to 2%. Add two data points which may shape this decision are both coming out in the week ahead. The first is the so-called Beige Book on Wednesday the 4th of September. The term's full name is the less snappy Summary of Commentary on Current Economic Conditions by Federal Reserve Districts. But at least that tells you what it does. All 12 local Fed banks describe how they're seeing things at ground level. More tangibly, on Friday the 6th of September, we get the latest non-farm payrolls data from America alongside the unemployment rate and wage growth figures. If we get strong jobs additions and wage growth, that could make it harder for the Fed to cut rates, while softness would add to their case. Although weak job numbers could mean the economy and corporate earnings may be about to slow, so investors may perhaps have to be careful what they wish for. Anyway, the figures released in early August for July showed the following when it comes to those US non-farm payrolls numbers. The addition of 164,000 jobs, which compared to a 12-month rolling average of 188,000. Unemployment rate of 3.7%, that's near a 50-year low. And wage growth of 3.2%, almost the fastest increase we've seen in the thick end of a decade. On the face of it, these are pretty strong numbers, but please bear in mind two things. First, jobs numbers are a lagging indicator, not a leading one. Just think of how long it takes firms to feel confident enough to take on extra expense and then go through the hiring process. It's not much fun always. Secondly, these numbers are subject to revision. This next graphic shows the net effect of two subsequent estimates for each month. The trend was strongly up in 2015 and 2018, down in 2017, and is sagging again in 2019. Now this might not be a great sign, as you tend to see downward revisions leading into economic slowdowns or even recessions. So, if you do look at the non-farm payroll numbers on the 6th, make sure you check out the revisions to the previous 2 months and not just the headline. Company-wise, there's a fair few firms of all shapes and sizes set to release results, a trading update, or host their annual general meetings, although only 4 hail from the FTSE 100. Names that may be worthy of note include packaging giant DS Smith, Restaurant Group and Michelmersh Brick on Tuesday the 3rd of September, retailers Halfords and Dunelm on the 4th, another retailer, Dixon's Carphone, as well as house builder Redrow and transportation specialists Dart Group and First Group on the 5th, and then house builder Barclay on Friday the 6th of September. But for me, the stock most likely to cause a big fuss in the week ahead is yet another house builder, this time Barratt Developments. The FTSE 100 member is set to release its full year results to the end of June on Wednesday the 4th of September. In contrast to those of some of its peers, shares in Barratt are up by around 15% over the past year. A series of upbeat trading statements have helped the stock shrug off fears over Brexit, the UK economy and cost pressures, to name but a few issues. July's trading update was also reassuring, and analysts will now get the chance to dig deeper and also perhaps get some guidance for the next financial year to June 2020. There are 4 key headline figures to watch. The first is the combination of completions and prices. Barratt has already stated that completions rose just under 2% to 17,856. That's still below the 2008 peak figure, so let's see if management gives any steer on how close it will get to the 20,000 capacity in the year to June 2020. Meanwhile, last year's average selling price was a fraction under £329,000, but we've seen price growth slow here of late, both at Barratt and across the sector as a whole. After that, secondly, analysts will move on to the operating margin. This will be affected by prices, but also cost inflation and cost control. Barratt's already flagged its return on sales improved to 18.9% from 17.7% a year ago, though the average across the FTSE 100 and 250 builders is north of 20%. So let's see what Barratt may say about that going forward. Thirdly, the company's already said pre-tax profit will come in around £910 million, a year-on-year increase of 9%. The key in this instance will be how any profit guidance going forward stacks up compared to the consensus estimate for the year to June 2020 of a small drop to £888 million. Fourthly and finally, we move on to cash and the dividend. Barratt ended its last financial year with £791 million in net cash, and that helps to pay the divvy. Analysts are looking for 45.8 pence per share against 43.8 previously, enough for a 7.5% yield, and that's a figure that means Barratt ranks 14th highest in the FTSE 100 in terms of its yield. Also note that analysts are looking for a further increase to 47.1p in the year to June 2020. Thank you for watching, and I look forward to seeing you next time.